All right, let's talk about Games Workshop, the absolute behemoth behind the Warhammer universe. I mean, this is a company with a fanatically loyal community and some truly mind-blowing financial results. But does all that success automatically make it a great stock to buy right now? That's the big question we're going to tackle.
And look, let's just start with the numbers because, wow, in their latest report, core operating profit just exploded, jumping up by a staggering 28.5%. That's the engine of the business, and it is running hotter than ever, all thanks to incredible demand for their miniatures. It's just a phenomenal performance.
And it gets even better. The company isn't just profitable on paper, it is an absolute cash-generating machine. Cash flow surged by over 42%. I mean, that's the lifeblood of any company, right? And Games Workshop is just pumping it out, funding its growth, rewarding shareholders, and get this, doing it all without taking on any debt. So it's a brilliant business, no question.
No question at all. But here's the multi-billion-pound puzzle. The market sees all this success, of course, and has priced the stock way up here. But what is the business actually worth? What's its intrinsic value? The real value based on all the cash it's likely to produce in the future. And this is where things get really interesting, because despite those record-breaking results, our deep dive financial model, when we crunch all the numbers, it sends a really clear signal: sell. So how on earth can a company that's firing on all cylinders be considered overvalued? Well, that's exactly the puzzle we're going to solve today.
To figure this out, we first need to understand the tool we're using. We're not just throwing darts at a board here. We're using a pretty standard financial method to try and peek into the future. And that tool is called a discounted cash flow model, or DCF for short. Now, I know that sounds super complicated, but the idea behind it is actually really simple. It's just a way of figuring out what a company is worth today based on all the cash we expect it to make for years to come. We can basically break this whole thing down into 3 simple steps. First, we project out all the cash the company is going to generate. Second, we have to adjust or discount that cash for the risk that, our forecast might be wrong. And third, we add it all up to see what all that future cash is worth in today's money. So, let's do it.
Okay, step 1. And to give this stock every possible chance, we're not going to be conservative. We are going to build a very optimistic, a very bullish case for Games Workshop's future. So, we always start with what we know. The company has a rock-solid history of generating tons of free cash flow. That's the cash left over after paying for everything. And that history has led to a record year, which gives us a really strong base to build our future projections on. So here's how we're going to project that forward. We're assuming a really strong 12% growth every single year for the next 4 years. Now, why so high? Well, they've got a massive new factory coming online, which is going to unlock a ton of capacity. After that, we're still assuming a very impressive 8% growth as the company goes global and its IP, like Warhammer, gets even bigger. This is an aggressive forecast for sure, but you can make a good case for it.
Okay, so we've got our supercharged growth engine. Now for step 2, we have to be realistic and apply the brakes. We've got to account for the fact that the future is uncertain. And well, a pound tomorrow just isn't worth the same as a pound in your pocket today. In finance, we call this the discount rate. This rate is basically a single number that tries to capture all the different risks of the business. For a company like Games Workshop, which has a stable market and die-hard fans, our model calculates this risk rate to be about 9.2%. And that's the number we're going to use to pull all those future cash flows back into today's value. And this right here shows you one big reason that risk rate isn't any higher. The company is a financial fortress. I mean, it is almost entirely funded by its owners, the shareholders, with basically zero debt. That kind of financial strength is one of the things that just makes it such a high-quality business.
So, what happens when we combine our really optimistic growth forecast with our realistic risk assessment? This is it, step 3. This is where we get the final answer.
So the model takes all those cash flows we projected. It uses our 9.2% rate to discount them back to today, adds in the company's extra cash, and the result? A total value for the entire company of just under £5.3 billion. And now, this is the moment of truth. We take that total value, we divide it by all the shares out there, and the model spits out an intrinsic value of 15,973 pence per share. But when we compare that to what the market is actually charging today, 17,800 pence, you can see there's a clear gap. And that gap represents a potential downside of about 10.3%. And that is why, even after using really optimistic growth assumptions for this amazing company, the cold hard logic of the financial model flashes a sell reading. The price has simply gotten ahead of the value. So what does all this mean? It's not that Games Workshop is a bad company. Far from it. It's an incredible company. What it means is the stock market already knows it's a great company and has priced it for a future that is pretty much perfect. The current share price isn't just buying the business. It's buying a story of flawless execution for years and years to come.
But hold on. A model is just a tool, right? It's not a crystal ball. It's built on assumptions. So are there any powerful game-changing factors that might not be captured in our spreadsheet?
What could really change the game here? Well, what analysts call option value. And number one on that list, by far, is the Warhammer TV series with Amazon. I mean, if that's a hit, it could be a massive catalyst, bringing millions of brand new fans into the hobby. That potential just isn't in our cash flow model. It's kind of like a lottery ticket that could pay off big, and it seems some investors are willing to pay a premium for that ticket today. And that really leaves us with the final crucial question for any investor looking at a stock like this. Are you buying the incredible cash-gushing business that exists today? Or are you paying a premium for the market's sky-high expectations of an absolutely perfect tomorrow? Answering that question, well, that's what separates price from true value.